What a lot of people forget, when they ultimately sold that portfolio, they lost $2 billion. Silicon Valley Bank, they had 200 billion in assets under management. So losing 1% of your portfolio generally doesn't lead to the end of your business. What I find really interesting from a crisis management perspective, I think you will see Harvard Business School studies on the press release that they released the week of the 10th, because by saying, hey, don't worry, we don't have liquidity issues, you don't ever say that unless you have liquidity issues. And I think there's an opportunity. A lot of companies are looking at this from a vendor risk management standpoint. You had a lot of payroll companies had all their money at SVP. So there was one, Patriot, I believe, had 55,000 companies. They kept all of their money at SVB, $100 million in March 10th payroll was at SVP. And if the FDIC wouldn't have stepped in, all of those companies' employees, tens of thousands of people, would not have been paid. And I've had a lot of credit unions and community banks talking to me the last few weeks about how do we look at our payroll providers from the lens of vendor risk management, because it had never occurred to them that these payroll companies may have concentration risk. And for most organizations, you have more cash with your payroll company than all of your other vendors combined.
But before the housing crisis, which you mentioned, there was a law, Glass-Steagall, that separated commercial and investment banking.
Correct.
Repealed, and since that was repealed, we've now had the housing crisis as well as this situation. Do you think that would have helped?
Absolutely. We saw a lot of protections created after the Great Depression. The SEC, there were all these checks and balances put into place so that we would never have a bank run again internationally. So we would never have a Great Depression. Those, a lot were rolled back. We saw what happened in 2008 as a result of that. And then there were some more banking laws put in. Those laws were repealed under the previous administration. And certainly, time and time again, we find certain financial institutions and certain organizations are going to play right up to that line of legal and in that gray area, and it gives them no margin for error. The federal government has said repeatedly to banks and credit unions, and I've said this for years, so it's not new, you can outsource process, you cannot outsource risk. For credit unions to continue to adapt and thrive, they need to be moving into non-traditional areas for credit unions that they're funding. But again, I'm not saying take 100% of your investments and put them in a new market or technology you're not familiar with, but start to get in there. Most credit unions can, like I said, lose 1%, 2%, and not even know. So when a credit union provides car loans, they don't model 0% default. That's unrealistic. I find a lot of times when credit unions start to look at, to them, what are considered alternative form of investments, they expect a 0% default rate. Mm-hmm. But you don't have zero with cars and you don't have zeros with houses. So why are you expecting zeros in your other investments, like you said?